$5,000. One time, never touched again. That's all it took to build a portfolio worth over $600,000. No stock picking, no day trading, no financial advisor charging fees. Just 3 ETFs, 1 smart allocation, and a 30-year timeline. Here's the twist. There's a safer version of this same portfolio that turns $5,000 into $268,000, and a more aggressive version that pushes it past $640,000. Same starting amount, same 3 decades. 2 completely different endings. I'll show you both. And by the end of this video, you'll know exactly which one fits you. Let's start with a question. If I handed you $5,000 right now, would you even know where to put it? Most people wouldn't, and that's not their fault. The financial world has a habit of making simple things sound complicated. Terms like expense ratios and market cap weighting and geographic diversification, it all sounds like a language you didn't sign up to learn. So let's strip it back. An ETF is just a basket. That's it. Instead of buying one company and hoping it works out, you own hundreds at once, sometimes thousands. One purchase, instant diversification. Compare that to a regular stock. If you buy Apple and Apple has a bad year, you feel every bit of it. One company, one fate. Your whole investment rises or falls on a single bet. A mutual fund is also a basket, but someone's managing it for you, and that manager charges you 1% a year whether the fund goes up or down. Over 30 years, that 1% quietly eats hundreds of thousands of dollars out of your returns. An ETF splits the difference. It's a basket, but nobody's managing it. It just tracks an index. And the cost? A fraction of what a mutual fund takes, sometimes as low as 0.03%. That one number is the first filter we're going to use, and there are 2 more after it that matter just as much. The 3 filters. Every ETF in this video passes 3 tests. If a fund fails any one of them, it doesn't make the list.
Filter 1. Expense ratio under 0.2%. That's the yearly fee taken out of your investment, no matter what the market does. Most of the funds we'll cover sit well below that. Filter 2. Know what it actually tracks. 2 ETFs can both call themselves index funds and own completely different things. One might own 500 companies, another might own 8,000. If you don't know what's inside, you don't know what you're buying. And when the market drops, and it will, you won't know whether to hold or panic. Filter 3. Track record across multiple market cycles. Not last year's returns, not the hot fund everyone's talking about on social media. A fund that survived the dot-com crash, the 2008 financial crisis, and the 2020 pandemic, and recovered from all 3, is telling you something. It's stable, it's tested, it's real. 3 filters. Every fund I'm about to show you clears all 3. The 3 funds. The starter portfolio is built on 3 ETFs. Each one has a specific job. The first is VOO. That's the Vanguard S&P 500 ETF. It tracks the 500 largest companies in America: Apple, Microsoft, Nvidia, Amazon, and 496 others. When you buy 1 share of VOO, you own a slice of every single one. The expense ratio is 0.03%, the cheapest fund in this video. The annual average return, based on long-term historical data, sits around 13%. VOO's job is stability. It's the foundation. The second fund is QQQ. This one tracks the 100 largest non-financial companies on the NASDAQ. Technology dominates. Apple, Microsoft, Nvidia, Meta, Tesla. They sit at the top and drive everything. QQQ has historically outperformed the S&P 500 over long stretches. It also falls harder when technology has a bad year. That's the trade. QQQ's job isn't stability, it's acceleration. The third fund is VXUS, the Vanguard Total International Stock ETF. It owns over 8,000 companies outside the United States, Europe, Japan, the UK, China, India, Brazil, every major economy except America in one fund. Why does that matter? Because the US won't always lead the world. It has for the past decade, but investing is a 30-year game, and betting everything on one country over 30 years is a bet most people shouldn't take. VXUS's job is balance. 3 funds, 3 jobs, and here's how you split $5,000 across them. The allocation. Half the money, $2,500, goes into VOO. That's the anchor. Everything else is built around it. 30% goes into QQQ. That's $1,500, enough to meaningfully lift the long-term return without making the whole portfolio rise and fall with tech stocks every quarter. The final 20%, $1,000, goes into VXUS. Small, but not a token. Real international exposure without dragging down the growth story. That's it. 3 funds, 1 $5,000 deposit, never touched again. But before I show you what that turns into over 30 years, there's one more thing you need to understand, because most people do the first part right and completely blow the second part, and it costs them everything. What you actually do after you buy. Here's the hardest part of investing: doing nothing. Once the money's in, every instinct you have will tell you to do something. Check the balance every morning, react to every headline, move money around when one fund is beating the other. That instinct is the single most expensive thing in investing. What actually works is boring. 3 rules. First, hold through the drops. Your portfolio will fall 20, maybe 30% at some point. That's not a risk, it's a certainty. Every major downturn in history has been followed by a recovery. The people who lost money permanently weren't the ones who held. They were the ones who sold at the bottom and never got back in. Second, turn on automatic dividend reinvestment. One toggle in your brokerage settings. Every dividend the funds pay out automatically buys more shares. More shares pay more dividends. More dividends buy more shares. The cycle runs in the background for 30 years, and you never touch it.
Third, review once a year, not once a week, not once a month, once a year. If QQQ has had a great run and now makes up 45% of the portfolio instead of 30, you rebalance. Sell a little, buy a little, bring it back to the original allocation. If nothing shifted much, you close the app and go live your life. That's the entire plan. The 30-year payoff. Now let's talk numbers. Year 1. Your $5,000 becomes roughly $5,745. That's it, a few $100s. It looks slow because it is slow. And most beginners quit right here because they don't see the magic yet. But watch what happens when you keep going. Year 10. That same $5,000 is now worth around $19,500, nearly 4 times what you started with. You haven't added a single dollar. You're just letting it run. Year 20. The portfolio hits $73,000. The same $5,000 that took 10 years to become $19,500 just took another 10 years to become $73,000. That's compounding waking up. Year 30. $268,954. From $5,000. One time, never added a dollar. That's the starter portfolio. The bonus portfolio. But I promised you a version that turns $5,000 into over $600,000, so let me show you what changed. 2 things, that's all. Change 1. VXUS is out. The international fund gets replaced by VGT, the Vanguard Information Technology ETF. VGT owns over 300 U.S. tech companies. Apple and NVIDIA alone make up over 30% of the fund. It's pure technology, nothing else. The historical annual return sits around 21%, the highest of any fund in this video. It also drops the hardest when tech has a bad year. That's the trade you're accepting. Change 2. The allocation shifts. VOO drops from 50% to 40%. QQQ goes up to 35%, and VGT takes the final 25%. That's it. Same $5,000, same 3-fund structure, same 30-year timeline, just more concentrated, more aggressive, more upside, and more risk along the way. Here's what it does. Year 1, $5,930, a slightly stronger start. Year 10, $25,700, already $6,000 ahead of the starter portfolio. Year 20, $128,000, almost double the starter portfolio at the same point. Year 30, $640,041. Same $5,000, same one-time investment, a $371,000 difference from 2 small changes. Which one is right for you? Here's the honest answer. It depends on one thing. Not your age, not your income, not your goals. Your stomach. The aggressive portfolio will drop harder in bad years. sometimes 40%, maybe more. If you're the kind of person who will panic and sell at the bottom, that portfolio isn't for you. It'll make you poorer, not richer. The starter portfolio will serve you better because you'll actually hold it. If you can watch your account drop in half and not flinch, if you genuinely have a 30-year timeline and understand what you're signing up for, the aggressive version is where the bigger numbers live. Both work, both are real. The right one is the one you'll actually stick with. Everything we just covered assumes one thing, that you have $5,000 sitting around ready to invest right now.